Welcome back, guys, to Forex Beginner's Guide video 114. And in today's topic, we will be talking about what is technical trading. Technical trading refers to use of charts, indicators, and patterns to make trading decisions based on historical price data. Unlike fundamental trading, which focuses on the economic and financial health of the country or company, technical trading relies purely on price action and market behavior to predict future price movements. In technical trading, traders study patterns and indicators such as moving averages, support and resistance, and candlestick patterns to forecast the directions in which the market is likely to move. These technicals are widely used in various markets like Forex, stocks, cryptocurrencies, and commodities. Key concept in technical trading: price action. The core principle of technical trading is price action, the movement of price over time. Traders believe that all relevant information is reflected in the price, so by studying past price movements, they can predict future trends. In this approach, price charts such as candlestick charts or line charts provide visual insight into how the markets have behaved historically. Then second one is charts and timeframes. Charts are at the heart of technical trading. Traders use charts to analyze price data over different timeframes, example 1 minute, 5 minute, daily, weekly. Gold, XAUUSD might be viewed in a shorter term charts for day traders or in the longer term charts for swing traders. Technical indicators. Indicators are mathematical calculations based on the price and the volume of an asset. Some of the most common indicators in trading, technical trading, includes moving averages used to identify trends and smooth out price action. Relative strength index (RSI) measures if an asset is overbought or oversold. MACD, which is also called moving average convergence divergence, used to spot changes in the strength, direction, momentum, and duration of a trend. Bollinger Bands help traders access the volatility of assets and identify overbought or oversold conditions, and many more indicators. But these are the ones which are widely used by a lot of beginners. Support and resistance. Support is the price level where a asset tends to find buying interest, preventing the price from falling further. Resistance is the price level where the selling pressure tends to push and the price back that pushes price back down. Traders use these levels to identify potential entry and exit points for trades. Candlestick patterns. Candlestick patterns are used to predict short-term price movement. These patterns can reveal trends or signal reversals. Some common patterns include doji candles, as you can see here. A candlestick which with a small body indicating indecision in the market, or the second one is usually the most common one is the hammer candlestick, which looks like this the in the buy, which is with the low, and in the sell with the same pattern. The candlestick pattern that signifies the potential reversal. These ones usually show you what the reversals are going to be like. This shows the indecision, and then this one is an engulfing pattern. This indicates strong buying or selling momentum. If you see this, you can see a bullish engulfing. If you see that, then it's a bearish engulfing. Trends. Technical traders focus on trends, the overall direction of the market. The idea is the trends tend to persist. So identify a bullish trend, which is upward movement, or bearish trend, which is downward movement, that can help traders make profitable decisions. Trend lines and channels are commonly used tools to track trends and spot breakouts. This is something that you can see as a bearish candle. This is something that you can see as a bullish candle. This is the high, low, open, and close is the same as the opposite on the bearish one: high, open, close, and low. How does technical trading work? Number one, identifying trends. Technical traders look for trends in the market. If the price of XAUUSD has been rising for several days, they may anticipate the trend will continue. Conversely, if the price is falling, they may expect the trend to continue downward. Number two, using indicators. Once the trend is identified, the traders use technical indicators to confirm the trend or find the best entry or exit points. For example, an RSI over 70 may indicate that XAUUSD is overbought, signaling that it might be time to sell. Number three, analyzing patterns. Traders also look for specific chart patterns such as head and shoulders, triangles, double tops, bottoms to identify potential market reversals or breakouts. Number four, Setting targets. Technical traders often use risk management techniques like setting stop loss, take profit levels to limit their losses and lock in profits when price hits a certain level. Number five, executing trades. Once the analysis confirms a potential trading opportunity, traders execute the trade with the appropriate lot size, often using tools like leverage to maximize their return or small price movements. Why is technical trading popular? Number one, objective analysis. Apologies. Technical trading removes emotions from decision-making process by relying on data and indicators, making it more systematic. Number two, adaptability. The approach can be used in any market, at any time frame, and on any asset, whether it's gold or stocks. It's versatile and can be applied by both short-term and long-term traders. Number three, works in all market conditions. Whether markets are trending or consolidating, technical trading strategies can be adapted for different market situations. Example of technical trading in XAUUSD. This is based on the analysis. You might decide to enter a buy trade when the price approaches a support level or aim for a take profit target at the next resistance level. Let's say that you're buying XAUUSD and you notice that the price has been making higher highs and higher lows, indicating an uptrend. The RSI is below 70, indicating there's room for further upside, not overbought. Number three, you draw a support line at 1800 and see that the price has bounced from the level several times. This is an example that you can use in order to enter a technical trade. Risks of technical trading. Number one, false signals. Indicators and chart patterns can sometimes give false signals, leading to poor trades. Number two, market noise. Short-term fluctuations can confuse traders and result in premature trades. Number three, over-reliance on indicators. Some traders may overly depend on indicators, neglecting other market factors. So that was all about technical trading, guys. The next video will be about fundamental trading. And I hope you're watching all the other videos as well to learn and understand a lot more in detail before you jump right into trading. So on that note, guys, I'll see you guys in the next video.